Okay. All right. Good evening, guys. This is Ken at Tortoise Capital with the daily strategy podcast for April 23rd, 2020. So the daily reports and the notes that I'm going to cover on some of the mini lectures for tonight are in the download area for the handouts, and they're also posted at Patreon. I also posted the closure report and the speed run. And some case studies at Patreon also. So those are already there for your dining pleasure. So this is where we were yesterday. Let's get our little device going. So this is where we were yesterday. We had an inside day inside the river with a slight upward push, and then it fell back and closed poorly. Oh, I'm sorry, wrong one. Yeah, here's where we were yesterday. Yeah. So it had an inside day, and it closed pretty well, and it was postured to if it could get through Monday's open and then through the 10-day high, then there was no real resistance overhead to get to the long-term fair value. We had projected the RL30, the PSAR, projected the Dragon out, sort of keep an eye on where price was with respect to those three projected indicators. Price had come through the Dragon and the RL30, and the only one still holding it up, if you will, is that PSAR projection. So we're still on the right side of the angels, but we're like postured right at the end of a Dragon, and there's a large move available in either direction. So we went through all the structure of the support levels and the target levels. We remembered that we were in summer, but we were postured right on the boundary of getting ready to roll into fall. So if this doesn't start moving out pretty soon, then this could roll into the fall pretty easily. But we still have a long side bias. We're mindful that we're in bear normal, and we're also aware that the declining volatility has given us some reason to be optimistic about swing trading. We recognize that there was one leg pause, two legs pause, and now a probability of a third leg up would take us to fair value. And then if that next move is a retracement, then it has to hold the support level at the Bollinger Band mean, the RL10, and then the belly of the Dragon. If the belly of the Dragon collapses, then this is a collapsing Dragon. Otherwise, any short side entry breaking through here would be a pocket entry to the downside. So we're in a very vulnerable state, and we're preparing for large moves in either direction. And then what we got was a reasonable upside open. It pushed through the blue line, which is the weekly open, and it briefly eclipsed the high of the day from yesterday. But then when right around noonish, there was some negative news from Gilead Sciences that their therapeutic drug really had not performed very well in the study, and the entire market responded to that in a matter of minutes, single-digit minutes, and sold off harshly. Found some support at the skin of the Dragon, but did not close very well. And what that shows is just how vulnerable the market can be to individual news items with respect to that treatment. Now, it's news for just one company, but it has an impact on every single country and every single economic activity in the future, and has, potential of trillions of dollars of differences in performance going forward. And so that's why the market immediately responded in such a nervous way. So it really hasn't changed its posture much from yesterday. It's one day older, one day staler. It was still a relatively narrow range day. It's still being propped up by the southern skin of the Dragon and the Z1 edge of the river. But the new 10-day low is in sight. That's 1 day's worth of travel down to the 10-day support level, the 10-day low. And shortly thereafter, the PSAR then the Bollinger Band mean, then the coming back over here, the belly of the RL10. So I cleaned this up a little bit. I added in the language of all those items that are keyed into those support levels and tracing them back to the source of the support or the resistance. So hopefully this is starting to be a little easier to read and a little more routine. So the PSAR flip, the Bollinger Band mean is extended here. The RL10 belly, which was the end of that first leg up. The Z-1 extension here. The strong support at the belly of the dragon. This is the Z-2. The furthest back belly of the RL10. And then finally the maximum adverse excursion, which is also the 30-day low. So here's our 30-day range. That's the 30-day look back to here. Then the 10-day range is from here to here, starting to narrow up. That's just how tightly sideways this has become. And that's why, not just on a daily basis, but really weekly and a 10-day swing period, this is becoming a sideways quiet channel with a large move in either direction possible. To the upside, we have the RL10, which is also the 10-day high. So that's the RL10 peak and the 10-day high. The Z2, the RL10, if we go back over here, there's an RL10 at about 35 days back, then the long-term fair value Z3, and then this is peak RL270. That was the highest that the long-term buy and holders had ever been able to push the long-term fair value up around 324. So it's only sold off about 8%. So I discovered this one yesterday as I was fiddling around. If you make a in TC2000, for those of you guys using that, if you make a vertical trend line, you can set a parameter. It'll automatically calculate the percent difference between the two endpoints. So I just made that vertical, and now I dropped that down to where price closed from the tip of the dragon, or the peak of the dragon. And so it's 21% off from that statistical hump of the dragon. So that cleans up that right side of the chart a little bit and makes this a little bit easier to read. So we now have a structured scaffolding that's going to be our routine for the north and south targets and support levels, support and resistance. And then we're going to use these three projection lines to give us the estimate of the previous strength of trend. So I sort of learned that technique from Dr. Gil Raff, who used to live up pretty close to my dad. He was a heart surgeon and a radiologist and an artist and a mystic and a beautiful photographer. And he wrote the book on the Raff regression channel. And the idea behind that was that he would take a look at the trend, and then the regression channel would be he would draw the regression line for whatever that look back period was, and then the regression channel was formed by the maximum excursion from that regression line on either side, and then that was symmetrical. And so his logic was that that channel will remain in place as long as the underlying truth of the market, plus or minus some noise, keeps it inside that channel. Then whatever is driving the market hasn't changed. So what I learned was to delay that by 1 day so you could see if today's price action violated that norm. Well, this is a modified version of that, in the sense that what we're looking at is the slope of these various trend lines and price action, and seeing how it compares to our forward projections to give us an idea of the evolving nature of that price action. Okay, so that's the purpose behind those three lines. That's an emergent quality of our analysis, but it feels correct to me. So looking at the 4 seasons of MACD, we can see that we're still in the summer, but that has now kind of come in, that train has come into the station, and that slope is basically flat. And so if we don't get any upward price action, if it just rolls over, then this is, or even just stays flat, this is going to roll into the fall, and then it gives us an extra reason to be guarded about our excursions to the upside, then even more we should be respecting the potential of those moves. And today's little intraday sell-off is an indicator of just how quickly that truth can change. So when the market is in this kind of condition, you have to pay more attention to the shorter term moves, because that's where the volatility is first going to be expressed. And then that agitation spreads out from the shorter term to the longer terms until it gets out to them all the way out to monthly charts. So I'm going to discuss that in a little more visually when we get to the notes section. So that's the quick look at today. We're still postured, about in the middle of the 10-day range. Strong support and resistance on either side of us on the 10-day high and low. And this thing is just cooking and waiting to see what the next move is going to be. We haven't had the decisive move yet out of this, what's becoming a congestion zone. And now you can see that the dragon slope has rolled over and is starting to flatten out. And that would lead us to increase the probability of a downward move. The flatter this is, that means the less and less influence this buying power has. And now it's open to a coin flip about which way it wants to go. Okay, so that's that. Looking in on the sectors today. So the S&P was basically flat, minus 0.02. What was better than the S&P, you ask? Well, the Dow was micro better, and Dow, Japan, Treasuries were all micro better. Healthcare and basic materials and the Russell were measurably better. And then, let's see, lumber, commercial real estate, energy sector were very strong today. Today it was the energy. And then I want you to notice Nucor, Cliff, Devon, and Win. All of our little specials did very, very well today. This quality of XLB and basic materials plus energy to be better than the S&P started right from the opening. So using that little radar screen or logic chain, we're able to pretty quickly find the movers and then begin to exploit them. So by the end of the day, Win and Devon we're up over 8%, Cliff up 7%, and so we're going to see some bar by bar action on that one. Just quick identification of short-term trading opportunities, and again, I use both of these charts to help me look for one-day pops, one-day swing trades, and on any day when one of these starts moving, and I can lock in R. Then I do so, and I don't see any reason to carry it overnight. So I'm posturing my shorter term trading now to be influenced by these little swing trade compression setups. So I am swing trading one day at a time as an adaptation to the tactical conditions that we're finding ourselves in. Okay. So this one is the auto framer. And again, what we're looking at is reference data, high, the low, the range, the average range, and the ATR, and 10-day highs, so that we can find out which targets have the best possibilities. I take them. Sorry, this one again is the squeeze. So this one I'm looking at the today's range and then the average range. So we'll look at treasuries right now. So treasuries had a range of $1.33. Their average range is $4, right? And what that means is that today's range was only like 1/3. It was only 30% of the average range. That's how tightly compressed that was. So even if we go all the way to the bottom of the stack and look at Microsoft, its range today was only 53% of its average range. So all of these are featuring very tightly compressed ranges. And then what that means is if they then go ahead and make a range stat move out of that range compression, then you're going to get some amazing reward to risk ratios just on a 1-day pop. So almost 6-1 on treasuries. But Procter and Gamble, JP Morgan, Intel, Home Depot, the Dow itself is at 3.3-1. So that, in a nutshell, is a reason to be interested in the Dow. There's mid caps at 3-1, financials, basic industries, technology, Cisco technology, and Microsoft. There's a nice little cluster of technology for a mini radar screen, a little mini logic chain for you right there. You pick those two, XLK, Cisco, Microsoft, come up and grab Intel, and now you have a really nice structure of technology stocks that are ready to pop on short notice, right? So let's, just so you can see what that looks like, let's take a look at XLK just for a moment and see what a 3-1 reward to risk ratio looks like, if this will cooperate with me. So this is technology, and it closed poorly, but it's still equal to or above its dragon. So what we would do is we set this tiny little box on here. That's about 0.3 of its average range. And so what we would like to see is we would like to see it open inside the yellow zone and then make a directional move. And then if it breaks out of that box and then just does a range stat move, we could get 3-1 on a single daily move. So if you look at some of these other ranges, look how directional these things can be. Like 2 days ago, it opened inside the previous day's range, broke down through the skin of the dragon, and had it just had a straight run to the bottom and then recover. That sets up a nice intraday trade, which if you wanted to, you could try to hold for a swing. But my typical play on here is just simply to trade it intraday and capture that move on the range expansion. So the same thing happened on this day. Look how once it starts moving, the large range days tend to become more directional. And then this one gapped up and sold off sharply. So you can make a living just on those intraday directional trades on symbols that have tightly compressed, and then make an orderly move, an orderly exit the next day, and then start making their move. So I'm going to be looking at XLK like that tomorrow. And then if we can find this Microsoft in here, no, let's see if I should probably put Microsoft back on my. So Microsoft is in kind of that same condition, has a very tightly compressed, and really over the last 2 days it's been tightly compressed. So now a breakout in either direction in Microsoft, if it just makes a range stat move, you can get 3-1 this way or 3-1 that way on a strong directional move. And now look at Microsoft, how it moves on those large range directional days. It's been a tech leader. Look how strong that is. And it's still not below its dragon. So that's one of the stronger plays, and it's above its PSAR. So you could, in this case, if we saw the market up and technology better and Microsoft better than XLK, then that's how you find the mover. And then that becomes one that I actually would want to hold as a swing trade, particularly if it can get above this RL10. So when I'm trade framing, I would start this off as a hybrid frog, add a position if it broke out of that yellow box, add another position if it got above the RL10, and then hold 1/5 of that as a swing trade, paid for by the intraday move in technology. Because a move to the upside led by tech, led by Microsoft, would be seen as a resumption perhaps of that third leg up. So that's how I'm using that chart to make some adaptive short-term trades in a structured kind of a way. Okay. So this chart here gives you all of the mechanical trade framing that you need in order to construct those quickly and efficiently. This next one is the auto framer, and so this one is looking at a move just to go back and test the 10-day high as the target. So like the 10-day high in oil is 5.78, and the mechanical entry on it would be 292. So the reward, if it gets to its 10-day high, is $2.86. The risk is only 37 cents. So you get a 7.7 to 1 reward to risk ratio. So all of these are now postured to make like a 2 or 3 day move back to the 10-day high. And there's some interesting names in there. There's oil, but JP Morgan, real estate, Caterpillar, financials, DuPont, Coca-Cola, Procter, commodities, Boeing, Latin America. So there's some nice 1 day moves that could grow into a 2 or 3 day move back to the 10-day high. And you've got some very nice R multiples using a pretty wide stop. And then the highlighted risk is the risk that you would use. That's also listed in my risk. The range max tells you what the largest move it's made in the last 200 days. So if we do get one of those runaway upside moves, you shouldn't be surprised if it made a move like that. So if I was looking at Coca-Cola at 45, it's made a $6.71 move in the last that's a 15% move on today's price action, right? And Travelers is at 100, and it's made a $16 move in 1 day. So that's pretty interesting. Financials, XLF has made a $2.50 move in the last 200 days. Let's see how. So you can imagine what a what did I say that was, a $2.50 move. So that a $2.50. I'm trying to remember if that's what I said. 250. Yeah, $2.40. So now what I want you to imagine is that if it opened inside this yellow zone and then made a $2.50 move, this is how far it could move in 1 day, from 2140 to 2380. It could move all the way up here, the size of this second yellow box, if it just made a move like it's already made. Yeah. Well, what you would do is you would, let's say, if it were to make a move like that, it would not be surprising if if where it opened was also the low of the day. 2 times out of 5, the open of the day is within 10% of the higher low. So you could let's assume that there was no gap and it just opened where it closed. You would then structure this and you say, well, from the open, it could move that high, but it could also move that low. That's the size of the maximum move. And you could actually bracket that and say that's how much is in play. If you look at the range stat, that is the maximum reasonable intraday move, and then you could bracket the open with that. So we talk about that in the day trading course. So this is just to give you the idea on swing trading 1 day at a time, just how far these things could move on 1 day if it gets to be a runaway move. So we get lulled into a sense of complacency by the most recent volatility. Like volatility has already compressed so much in the last 30 days that we're used to these small range days as they start compressing. But as 40 days ago, it was making moves. Look how big that move was over here. These 1 day moves were huge. And so we could get a day just like that on some bad news and bad momentum. You could see if it opened where it closed, it could move in either direction the size of one of those yellow boxes, and it wouldn't be surprising. So we've got to be prepared for that that kind of eventuality. So this is not a prediction it'll do that, but I want to know what what it's done before, so I can have some kind of I can condition my my brain to be ready for those kinds of moves, or to not be surprised if it starts running away in a move like that. Okay. Um, if I go back to XLF, just the final piece of structure here, the average range has only been $1.03, right? And so if I now come back to, if I come back here and I draw a dollar size box, just to show you the difference in between normal and abnormal moves. This box is $1. So if it opened where it closed and then just made an average move in either direction, it would make that kind of move. So the difference between this big fat box and the tall skinny one is the difference between the average move and then the maximum move that it's made in the last 20 days. So so you can, even on a an average move, you can get a nice 1-day move. And that's one of those in a bare normal condition. If you can get a bird in the hand, why would you want to take any overnight risk? Look at the size of the some of these overnight risks and gaps. That's one where it gapped more than an average move, and there was a big gap, and here was a big gap, and here's another big gap. So I don't like taking that risk overnight in bear markets. So I am inclined on this kind of market to de-emphasize the overnight holding on swing trades and really emphasize the intraday moves, and try to get paid 1 day at a time. So Richard asked me, is the assumption that the market will move higher when considering the 10-day high? So, well, that's one of the three things it can do. I mean, it could move higher, it could move lower, or it could just move sideways. So when I start calibrating my expectations or anticipations, all I'm doing is looking for the size of the previous moves that it's made in each direction, so I can start estimating what the normal moves in any direction could be. So if I start seeing those kinds of normal moves, then I can start anticipating what an abnormal move might be. So how do I assess the direction after the open? I look at the direction. I assess the direction by looking at the price and seeing which direction it's moving. That's how I assess the direction. I look at it. And if it moves through my support levels on the way down, then I'm probably going short. If it moves through my resistance levels on the way up, then there's power in the buying, and then I'm going long. So I'm not trying to make a probability estimate of which way it's going to go or guessing. I'm waiting to see. And then when it moves a certain distance in my favor, well, yeah, it can be very volatile at the opening. And so one of the things that you see me doing is using the frog box or the hybrid frog box as a measure of the difference between signal and noise. That's in the day trading course. Okay, so that's what I want to say about that. All right, let's. You'll see some examples of this unfold today, exactly the way I just described it. So we went into the day ready for large moves in either direction and a tightly compressed ranges. And the material sector yesterday did very well. And the energy sector got smashed yesterday. So both of those sectors had extremely large moves relative to the rest of the market. And from those extreme conditions come extreme results. So I was ready to trade either one of those at the first sign of directional moves. So when I come up here and look at when I stack this by percent gain, I can come down here and I look at the S&P. Now, it's right now at 0%, but there was a time when it was up 0.5% today. So if the market is going up, then I want to look for targets that are doing better than the market. So that's how I quickly find things like, oh, the energy sector is much better than the S&P, and Devon Energy is much better than energy. Look at this. The S&P was flat. Energy as a sector was up 3%, but Devon Energy was up 8.5%. Well, some of that strength was manifested early. Here the S&P is flat. XLB was up 0.7%. And here's Cliff up 7%. So it's doing better than the sector, which is doing better than the market. So that tells me I want to be long that symbol. All right, so that's we call that finding the mover, and it's in the day trading course. Yeah, Van, I sent you the link to the chain trading. Listen to that little short opening video on that one about how we start with a hybrid frog and then move towards either an owl or a collapsing dragon as a way to get started during the day. We're going to see that. We're going to see that today. Okay. Let me get back to our screen. All right. So those two charts. So the reason I've been hitting these two charts hard is because when the market is in bare normal conditions and is located in a critical state, that maximizes the possibility of sharp directional moves in either direction, because everything has been squished into a very narrow range. And then as soon as it breaks out of that range, you'll start seeing the momentum players come in and start reinforcing that move. We're trying to fight and take it the other way, but you get the tactical tug of war between buyers and sellers right from the beginning, and whichever group wins that, it ends up becoming a runaway momentum move, and then that momentum brings in more momentum, and then the higher time frames start to see directional moves, and then they start coming in. The 10-minute traders, the 30-minute traders, the hourly traders, the daily traders, the longer term traders. If the momentum just keeps working, then more and more money is enticed into the trade on that side, and then the momentum just takes off, and you get these rocket moves like we've been seeing the last 6 weeks that have been giving us double-digit R moves. So you can't tell ahead of time if that initial breakout is going to lead to that. But you have to start with the assumption that it could. So you play the breakout, and then as soon as you can ratchet your stop up to get to no lose plus dinner for two, then your seed capital, your seed corn, is removed from risk. And now it's a science project to see how much money that the market's going to reward you with. That's covered extensively in the boot camp video, the psychology of that short-term trade and the psychological state change that you will experience when you go from having your money at risk versus the market's money at risk. Understanding that distinction allows you to trade in those shorter time frames without losing your mind. It allows you to preserve your emotional bank account so that you don't run out of the will to trade. You don't get so consumed by the anxiety of watching the trade. You just trade it. Part of that is just building up a callus. You gotta do a lot of trades. You gotta carry a lot of sandbags. You gotta carry a lot of bricks to build up calluses on your hands to get that thicker skin to deal with the tactical trading. That's why I believe traders got to trade. You got to trade a lot to build up the almost dispassionate approach to the task. You have to make it You have to grease that groove and render it into battle drill and technique. That's craft knowledge, in my opinion. Is that the only way to do it? No, it's the only way I know to do it, though. So I can only teach you what I know. I can only try to teach you what I know. So the reason I've been paying attention to these two charts then is because they find candidates every day that are postured to make larger than average moves in either direction. So it doesn't matter which direction the market is moving. The trading simulator that I would use, Richard, is TC2000. And I would trade the market live forward and get a lot of reps on it with an accountability partner, or trade one share at a time so you get lots and lots of reps. Like at Interactive Brokers for a penny a share. Trade one share. You trade for $1 of commission. Trade 100 times with $1 at risk. You'll learn more about trading by trading live 100 trades for one share and trying to follow the rules with skin in the game and using your broker as the simulator. That's how you gain proficiency, in my opinion. Trade one share. Trade it forward. Now, you can also, if you get a quality trade simulator, you can get lots of reps in there so that you're not waiting, for every minute to pass for the next minute chart. You can actually trade by rules. And what you have to watch on there is that you have to have the same mindset when you're practicing as you will use when you are live trading. If you don't, then all of the practice in the simulation is actually creating conditions for you to fail. So in my view, you have to replicate the conditions as much as possible. That means you have to have skin in the game. So I just say trade one share, and then you'll find out what your actual slippage is, and you'll have skin in the game. And emotion, because of the four things you have to have: time, will, pattern, and money. Will, the emotional commitment to be professional and to keep going and to follow your rules, regardless of the particular results, but just sticking with it and not getting emotionally exhausted by thinking each one is going to be the one that wins, and when it doesn't, you suffer an emotional drain. You got to get past that. You got to be disinterested about the trade, attentive, professional, but you got to get in there and make bricks and build the wall and carry sandbags and cut wood, chop wood and carry water. You got to get that stuff done. So I emphasize these two little trade reports here because these are ones that are postured for strong one-day moves far more than the other members of the Dow and the ETF 30. These are the ones that have the best risk-reward ratios, that if it pops, these are the ones that will give you the biggest bang in the shortest amount of time compared to everything else on that list as it goes down the list and things not on that list. Okay? So that's why I look at those. All right, let's shift gears now and take a look at some trades. So here is the energy sector. And let me get my little cursor. Damn it. Pardon my language. Get my cursor drawn on here. All right, so we start off with a gap up opening. And so the energy sector is already better than the rest of the market. So I wait about 5 minutes. Here's what it did. It gapped up and then just traveled sideways for like 5 minutes. And then the RL10 made a high, so I highlight the peak of the RL10. Now, that's the peak of real price value today so far. So I want you to conceptualize, or actually just draw it on your chart. Just draw that blue line across from the top of the RL10. Now, if it goes above that RL10, then that means not only did it gap up, but it has now exceeded the 5 bar the 5-minute high, that opening range. So that's interesting. And now after 5 minutes, here's the 5-minute low. If it breaks down below there, then it would have made a new crap. It would have made a new low for the day. So that's your little opening range of the first 5 minutes. That's a reasonable way to approach all this. Get my other yellow circle out of there. All right. So I noticed the VWAP is like right in the middle of that blue line I drew at the peak of the peak RL10 and then the current low of the day. Now, if I go to Van, you asked me about this so the hybrid frog is a way to bracket the open with a box that we describe as the difference between signal and noise. All right. So let me go back to our daily report, and I want to. So when you're framing trades, so I'm interested in the energy sector right here. So I'm going to go to the tactical ETF page on the daily report, and I'm going to come in here and look at. Let's see, view, zoom to selection. All right, so now I've zoomed in on my daily report. So I'm going to come down here to XLE. This is row 30. And then I'm going to look at the hybrid, the frog box. The frog standard deviation is 85 cents. That's the difference between signal and noise intraday. So from the open, if it goes more than 85 cents in one direction, right from the open, then it has moved a frog box. And that's the difference between signal and noise. That's the beginning of a directional move. Anything less than that is still partially noise. So what we do is we take 70% of that, we call it the hybrid frog, and I come down here and I say, 60 cents is a 0.7 of because I'm using 0.7 as the multiple. So 60 cents is 70% of that 0.85. So I know that since I want to trade energy, I can now come over to the energy trade, and I'm just going to I'm going to draw a box to show you what 60 cents looks like here. A nice thick box. I didn't know this was going to be the lesson, so I'm just working my way through this. So that's from 36 to 40. So that's a 60-cent box. You could put a hybrid frog box on either side. Lately, I have just been straddling the open with that size of a box. All right. When we talk about the hybrid frog, the way I teach you to do it is to take a 70% of a frog box and then bracket the open. And now what we would do is we would leave that in place and we would wait for price to break out of that box in either direction, right? So now you see where I drew the red line here? I drew that below the 5-minute opening because I want to get in earlier than even the hybrid frog. So I'm doing an adaptive trade. So if it broke down below there, I would get in. Or if it broke above here, I would get in. And that's the hybrid frog. Now, one of the things that you'll get paid is the smaller that you can make your minimum manageable risk box, the sooner you can get your risk out of the trade. So what I have learned to do is to make my box even smaller than the hybrid frog box. I don't advise doing that until you've had a chance to practice this stuff. So what I've done is I've now made my box this big. And I've said, look, that's the highest high of the first 5 minutes and the lowest low of the first 5 minutes. And I drew my lines. Sorry. Come on, can I? Yeah. So I drew my lines at the peak of the RL10 and the low of the day. And I made a commitment that that would be my minimum manageable risk box. Now, what's that do to me? Number one, it means I can get in at this blue line. Stand by. I can get in at the blue line instead of the green line. And I can, or I can get short at the red line instead of the second green line, or that red line. And what that means is, if this thing now breaks out of my little yellow space, I can get long at the blue line. And then in the hybrid frog system, you guys have the rule sets for that. There's a statistical advantage for letting it move that far. If it moved that far, you have reason to believe that this was a directional move away from the opening and not just noise. So this opening 5 minutes is just kind of noisy. But if I wait for it to get through the green line and it turns out to be a big, strong move, then I will have missed this opportunity to win between the blue line and the green line, and while waiting for confirmation of a directional move. So what I have decided to do is I'm going to bring my moment of entry from here at the green line all the way back to the blue line. Now, what that means is that sometimes that's going to fail. It's going to fail. Whereas if it gets to the green line, it is an increased probability of going, but then my reward is lower. That's covered in that hybrid frog and the advanced day trading course. But what you notice me doing now is I'm using a much tighter stop, a much tighter manageable risk box, and I'm using in this case, the hump of the RL10 and the belly of the low of the day, and I'm going to just trade it in that direction. And then my job is, if it moves up here, like between the blue and the green line, then my job is to move my stop above my entry so I can get my risk out of there. And then if it comes back and hits, if it just comes back and hits me here, I'm out with a little fractional win. I haven't lost any of my trading capital. It just fired and missed and got paid a little bit for taking the shot. But if it does go and then gets through my green line, now I can put a second position in, and then my job is to quickly get my my stop above that one. So now both positions are in the money. And now it's really a science project to see how much I can keep. You've seen me trading that way now every day for 6 weeks in a row, and you've seen the results. So how do you get proficiency at this style of trading without losing your mind? You start with the hybrid frog, and you start with those wider boxes, 70% of a frog box. And then you start, as you get proficiency and it becomes routine for you, you start shrinking the size of that box. Instead of 0.7, maybe you reduce it to 0.5. And now you tighten up the that manageable risk box, and now maybe it's 0.5 in either direction. And then maybe you make it just a single 0.7 frog box like this one looks like. As you start shrinking your minimum manageable risk box, this is what happens. You will get more scratch trades and some fractional losses, but you will more quickly get your winning trades to no lose plus dinner for 2. And then the winning trades will have larger R multiples because you got in sooner when things were more uncertain. So there's only so much money that you can make on a particular move. and you don't know ahead of time how much money that trade is is potentially going to return. So let's say from this opening that the actual move is going to be something like this. Well, you got to tell me how far away from the open you want to go before you enter. If you are trading the hybrid frog, you got to wait to see it's going up, 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 it's going up. It hits my green line. I'm now long with a hybrid frog. If you're using the minimum manageable risk box that I've been describing by taking out the hump of that RL10, it moves, it sells off a little bit, it mucks around. If it starts going up, I'm long. It moves about that far. I get my stop from here above my entry, and now I'm not going to lose any money on that trade. And now just manage the trade. Up it goes, up it goes. As it starts moving up, it's testing where the hybrid frog is, so I'm trailing it, trailing it, trailing it. It's going to get through that green line. Come on. Come on. When it gets through that green line, I'm going to move my stop north of that, and then I've got two positions in free and clear. Okay? So that's the concept behind the hybrid frog. And then once you get that first position going and that first trade under your belt, you're starting to get a lot of information. Sorry, revealed the wrong one. Or erased the wrong one. You're starting to get a lot more information about what kind of a day it's going to be. It's less potential and more actual. And now you're into trade management. So I want you to go look at the earlier podcast that talked about all of the different strategies for managing and strategies for exiting, and that will give you some ideas about trade management. I think I'll cover that one in greater detail this weekend. So here we are. So our trade, let me clean some of this crap out of the way so you can see the actual trade. Okay, so I get rid of my cursor too, didn't I? Okay, so here we are. So the trade opened here. It pushed up to the blue line, didn't stick, came back, and now it's just mucking around. So I've still got my blue line and my red line and my minimum manageable risk box. The VWAP hasn't really moved. It comes out of the yellow zone. I buy my first position long. I'm interested in the long on this one for the following reason. The market gapped up, energy gapped up, and it was stronger than the market. So I'm not interested in going short on that one. I'm waiting to see it break out to the upside because I believe there's upside. So I'm not trading the short side on this one. The market was up and energy was much stronger. So I'm not going to go short the strongest sector in an upward market. I want to go long. How do I know when it's time to go long? After it mucks around, and then breaks out of my RL10 bucket. Now, here was a place that you might have considered getting long earlier. You've seen me get long here before when it bottomed out, made a PSAR flip, and then crossed the VWAP. I had committed to waiting to see it break out above the RL10 and make a new high of the day. So I get long here. You could legitimately get long there. I'm going to leave that in place. So it's a fractional gain. That would be a fractional improvement. But if I get here, then the risk of losing is greater. But then how much you lose is half of what you would lose if it was up there. So choose your poison. So I get long here. My stop is down here at the red line. It pulls back, keeps support at the PSAR, takes out the hump of this RL10, I'm already feeling good about this one. My job is to figure out how soon can I get my stop to no lose plus dinner for two. How soon can I get my stop from here up to, well, like right now, I could be here right now and I would be happy. Why? Because my exit protects me and my capital from any loss. So I'm at no lose plus dinner for two, and this thing is going up. Hooray. There is my green line. That's the hybrid frog entry from the open. That's that 60-cent move. If it breaks through there, then I really feel good about this, because the hybrid frog is a statistically good entry. It's perfectly reasonable to wait for that. Because remember, this thing could move $2 today, and I'm only giving up 60 cents waiting for it to make a directional move. There's nothing wrong with waiting to the green line. It's just a different system. That's the hybrid frog entry. But I've got my entry here. I could have had that one, but I took this one. Now price is here. My stop is at the red line. Now I'm just managing this trade. Could have entered here. If I had entered here, and if you had added a second position here and saw this move up and then exited here to basically scratch the second entry, I have no quarrel with that. No quarrel whatsoever. I didn't add to the position. I was trading this with relaxed money. So it moves up to here. I'm just following the PSAR. I would not object if you just take this exit. I didn't take it because this was doing better than the market. I was willing to give it more room to run. It pulls back. It basically achieves the previous hump of the RL10, makes a higher low in the RL10. Now when it clears these previous two, I decided to add a second position. Get that out of there. So now I've got my second position in. By the time it's moved this far, I should be at the PSAR. Now here's what I've achieved. By front running that hybrid frog with this adaptive entry, I've got two positions in, and both are in the money, and even the second position is not going to lose any money. Sorry. Because my stop is higher than my entry, and I feel really good about this one. I take that exit right there. I then decide the energy market is starting to suffer. Oil started getting hit hard. I now notice this is an owl entry. So what are the criteria of the owl? Sing along with me at hope. No, this green line would have been a failure of that hybrid frog. So if it had moved up through here, this green line was the hybrid frog entry. If it then moves up and then fails below there, I would take that as a reason to get short and then come back to the VWAP. And I see it rolling over here. And now let's count off the criteria for the owl. Unambiguous move up. Yeah, anything that's better than a hybrid frog move off the open, that's a full frog box. That's already an unambiguous move up. Then it makes a P1 outside the river, which it did right here. Regression line crossover outside the river, makes an RLXD. The RL10 crosses the dragon. The dragon rolls over. The RL30 rolls over. This is an owl short. This one is a PSAR exit. 5 more bars and it continues to fail. Now notice that it failed through the RL270. And the Z3 lines have rolled over, and the RL90 has rolled over. This for me is a short, and my target is the VWAP. That's the fair value of the intraday price. So I'm willing to capture that. That's a 40-cent move. And then if I'm short here, my stop is only 20 cents. I'm using the PSAR. So I'll get short here with a tight stop. By this time, I've already got my stop, which was here. I've already got my stop moved down to here, and now I'm not going to lose any money on that short. That's an owl. Now, so our target was to come down to the VWAP. That would be the least surprising move. But it didn't. It gets this far, and then it makes a 1, 2, 3. And now notice the RL10 just rolled up and starting to enter the dragon. So I'll capture that move. I'll get paid, make bank. And now notice that it's almost a hybrid frog box off the low. Now if it crosses up through the green line, I'm ready to get long again. So we got paid a little sandwich and collect a fractional gain. So that's intraday trading. So it makes a little run up, pulls back, makes a higher low in the RL10, still finding support above the VWAP, and now you get an RLXD and a PSAR flip. Notice the dot on the PSAR has flipped. I buy that. All right, so let's review the psychology here. Unambiguous move up, cash it, get paid. Rolls over, there's an owl short. Fails to fail further, cash, wait. RLXD, it's now a pocket entry going long again. So I buy it here. My stop is at the PSAR. So there's my stop. And there's my target up here. The hump of the dragon, the Z3 excursion, and then the second Z3 excursion. So those are all 3 price levels that this little entry could get to. I think it could get to here, like it did. It could get to here, which was a Z3 excursion before, and then it could get to this one. If it gets above those 3 lines, this thing is on its way to a $2 gain. This has only moved about 80 cents so far. There's almost another $2 of upside if it gets through those 3 lines. And I'm getting an entry here on an only 20-cent risk. Dude, that's what I'm looking for. And then by this time, my stop has got to be about here. And now all of my risk from that entry is out of the trade. It's now a science project to see how much I'm going to capture. My risk capital is out of the trade. That's the no lose plus dinner for 2 trade management technique. How quickly can I get my small amount of risk out of the trade and get something locked in? I'm not scratching that trade. I'm getting paid about $50 after commission just for taking the risk and getting paid to manage that. That's what my fireman is doing, the fireman psychology. If you listen in on the boot camp, you'll recognize that lesson. So I spent a little extra time on that one because it's important to understand the hybrid frog. All right, we're now going to go to wheat and precious metals. So XLB was strong yesterday. It gapped up and was stronger than the market. And wheat and precious metals gapped up and was stronger than the market. It's in the 3rd day of an upward move. So what did it do today? This is where it closed yesterday. It gapped up to here, and notice how the VWAP ran up right away. In the first 5 minutes, it runs to the top, pulls back to the VWAP. So now, what am I going to do? What do I always do? I'm just going to draw that little risk box and say, that's my minimum manageable risk box. I don't mind if you draw it all the way down to the PSAR flip, but just to the southern skin of the dragon. So now if this thing, which is stronger than the market and had a strong gap up, if it breaks out of this yellow box, I plan to buy it because it takes out the hump of the RL10. That's my minimum manageable risk box. If it falls below this, I may want to get short and play it back to yesterday's close because it's failing. That would be a gap fail trade. The RL10 reverses. It's everything is north of the VWAP. The PSAR has never looked back. It made a new high of the day. I just buy it. Let me draw a red line for a stop. Right there. I'm using the VWAP as my stop. So I don't have much risk in that thing at all. By the time it's moved that far, now notice when it made a little hump of the RL10, pulled back, held support at the PSAR, and then took off again. By the time that price gets above the hump of the RL10, your stop should be like right about there at the PSAR. Now I'm at no lose plus dinner for two. I'm not going to lose money on that trade. That makes it psychologically very easy to manage the trade because I'm not worried. I just give this to my craftsman. My fireman is done, and I just hand it off to a journeyman. Just manage this trade. Now, if it gets above that Z3 line there, then this will be an exceptionally good move. I want you to notice this other green line. This green line was from yesterday's high. That was a line that on a swing trade, if it got above that green line on the daily charts, then I wanted to add a position. So this thing gapped up and is moving out, and I got no risk into it. And I know that if it goes up through this Z3 line, I'm going to add a second position. And if it gets through this green line, I'm going to add another swing position because I've already got 3 positions in here. If it starts to reverse here, then I use the 2-hour battle drill. Find the 2-hour battle drill video and watch it every day for 30 days. That tells you what to do. So my risk is out, and at this, I'm going to turn that blue so you can see it easier. At that blue line is where if I can't get a second position in before then by that time I should have a second position in. I like this one. It was already, if you see how much risk I had taken here in the yellow box, it already moved that far in my favor and had no sign of moving back. So I add the second position there, and now by about this time, I get to no lose plus dinner for 2. So if you're in the sound of my voice, anytime you see I have a green line up there or I have a purple line that shows a profit target or a resistance target, if it gets to that line and starts to reverse, I will always say, then the 2-hour battle drill takes over. So watch that video. That's the most important battle drill ever. You should watch it every day for 30 days. And I love that exit. That exit is an RLXD. So I get 2 positions in, and I finally make the exit I'm supposed to. Now, I want you to notice that compared to the energy ETF, the distance back to the VWAP is not that large. That's not worth aiming for, in my view, especially on a symbol that was one of the 3 strongest symbols in the market. It now makes an orderly recovery above the VWAP. It makes a PSAR flip and an RLXD. This is a re-entry on a pocket. That's the pocket trade. And now my upside move, if it gets up beyond this green line, I'm going to add a second position. If it gets above the humps of these Z3 excursions, I'm going to add a second position. So I take my position here. I'm using the VWAP as my risk, and off it goes. At that yellow dot, it could have failed, but it didn't. I want you to notice down here on the MACD, spring, it's in the summer, and now it's pausing. What's it going to do? I'm really interested in seeing. And notice the Z3 lines have pinched. This is now sideways quiet channel. The RL90 has flattened out and is starting to roll back up. So this thing is poised to make another run. How big could this next move be? It could be as big as this move, which is leg 1, pause. Leg 2 could be that big, and that would take it through this green line. It doesn't, so I just take the RLXD exit. I now observe it's going to come down. It's now testing, and now the RL10 has started to roll up, and we're very close to getting a PSAR flip. It didn't. The second yellow dot, it's now getting ready to make a run to the downside. Now notice we're in the winter. I have watched it now come back to the VWAP. Now I'm interested to see what it's going to do there. What's it do inside the sideways quiet channel? Nothing. So that was my moves. So this was my initial risk, this yellow box. And then entry 1 exits here. So on that amount of risk, on that yellow risk, that captured that much gain. The second position goes from here to here. It captured that much gain. This re-entry enters here with this much risk and captured that much green. So that's how much green I captured compared to that much yellow that I risked. And again, this green line here is the price level where I'm justified in automatically adding another swing position based on the daily chart. God, we're already an hour into this thing. I'm not going to get to the notes. Typical entry. This is Cleveland Cliffs. This is that steel making company. There's the initial risk. Minimal manageable risk box makes a new high of the day 5 minutes in. I just buy it. Second position. RLXD exit. Re-entry. By the time it gets to here, I'm going to move my stop to no lose plus dinner for 2. That's a big win. Routine. Next one. Devon Energy. We already saw XLE was 3% better than the S&P. Devon Energy was much better than Energy, which was better than the market. So this one, and we talked about this one yesterday, you'll remember. So 5 minutes in, I see the VWAP. It makes a breakout, makes a 1, 2, 3 entry. I just buy it. There's my risk. Second position, when it takes out the hump of the RL10, just leave it alone. By this time, I've locked in. I have moved my stop to the PSAR. I've locked in 1072 on the price. And as I was making that chart, it made another run up to about 1095 and then came back and hit my exit at 1085. So those on the first position, I risked this much. I gained that much green. Second position, on that much risk, I gained that second amount of green. So that's the 4 trades that were directional right from the open today. So what I want to say, this is what I want to say. Here's a sketch. I was listening to some of the questions and comments, and so I'm going to get a little philosophical now about hybrid trading. Hybrid trading matters right now because all of the time frames are blended together, and there's a maximum of chaos and volatility. So if you're a strategic money manager and you got piles of money, you want to make your decisions once a month and make monthly adjustments. A weekly guy is going to make 5 days in a week, and then a week and a week and a week and a week and a week. And he's going to make a daily guy is looking at a daily chart once a day. An hourly guy is inside each day is looking at 7 bars, one every hour. A 10-minute guy is looking at 6 10-minute candles inside each daily bar. And then the 1-minute guy is looking at 10 1-minute bars every 10 minutes, 6 times every. So you can just see how many decisions and readjustments and updates and assessments that comes at some cognitive cost for energy. So when things are orderly and lack volatility, you can afford to just let the monthly trend carry you right along. But look how much it lost, over 40% in 2 weeks. So if you were just going to make your decisions once a month, that guy got crushed. So when there's a lot of volatility, you end up shortening your time frame. So how thin should you slice the time to make? Daily, weekly, every 2 weeks? How much volatility is there? It tells you what ought to be your primary time frame of interest. What I want to tell you is that we have a set of standard patterns. You've heard me talk about the hybrid frog, how to get started out of a period of compressed volatility. The owl pattern, what to do when it's made an unambiguous move and is starting to reverse. What to do on a collapsing dragon. If it's sold off, starts to recover, and doesn't, the collapsing dragon shows you how to get back in. What if it moves up, pulls back, but then doesn't fail and starts to resume? Well, that's the emerging dragon. And then what happens if all that stuff gets very tightly compressed intraday or intra-week, sideways quiet channel? Well, then you can use the Z3 pinch and the sideways quiet channel. That's what the chain trading is on any time frame. Why? Because all of those patterns are and now we'll look at the process that are fractal in nature. Use multiple time frame, multiple lens analysis to set conditions for gains and losses, support and resistance on either side of the price, so that we can see where the road signs are for what kind of moves are available. That's all inside an ecosystem that ties those things into a sense-making proposition. And then we can use the principles of core and turbo to start blending the time frames, like I demonstrated at length yesterday with Tesla, on how I blended the swing trading and the intraday trading in both directions to take advantage of this ecosystem and all these fractal patterns. Well, when I talk about the multiple time frame, multiple lens analysis, and I talk about this ecosystem, what is it that ties these patterns into these processes? It's this framework, the regression line crossover Bollinger Band framework. And you heard me talk extensively about that on Monday with the Bollinger Bands, the regression lines, the river, the dragon, the MACD 4 seasons, how I use those seasonal slopes of the MACD line to establish my posture for some of these longer term movements. I described the regression line fractal framework to understand the size of potential moves between the RL10 and the RL270 and the logic behind that. The ideas of support and resistance, you've heard me talk about 10-day highs and lows, 30-day highs and lows, the belly of the dragon, the hump of the 10. And then the idea of pinching and stretching as things move out with volatility and then start to compress. We can use those volatility bands to help us understand where in the life cycle of pinching and stretching it. It's almost like the market is breathing. Study those ecosystem lessons in the boot camp to understand the sense-making framework that allows us to use these standard patterns in different time frames and blend them together in an ecosystem so that no matter which time frames we're looking at, we're making the same kind of sense out of it in the same way. So this is what I want to say now about learning. You guys have been asking me tactical questions about, well, what if it gets to the green line and starts to fail? What should I do? Well, there's a rule for that. That's a tactical decision to make. The reasons I make the decisions I make, the reasons I'm applying those rules in that context have to do with some of these other sense-making layers, the calluses that have been built up over thousands of trades, where I'm applying these different patterns and these different processes and these different levels of support and resistance. All of those give me different perspectives on the context of the market from many of these different angles. Now, I've internalized all these because I've been trading this way for 30 years. I'm trying to describe to you all of those different layers of context that are represented by these patterns and processes and this sense-making framework that allows me to interpret the price action and then pick the specific rule that I want to use, like a hybrid frog or a minimum manageable risk breakout or the RLXD, or a 1-2-3 exit. That's a particular rule that fires. It is in our nature to want to get immediately, hey, what's the rule and how do I do it? But if all I teach you is the rule, but I don't give you the context, then you're going to be confused by the rule because you start asking questions about, well, what if it's this and what if it's that? That's where all this other context comes from. The boot camp is part of the paid subscription service and the learning management system for folks that are subscribers on Patreon. That's what they're paying for, is for all those structured lessons that I'm describing here. So the tactical rules that you've seen me applying come from these layers. It's almost like calluses on your hand or an onion skin that has multiple layers of making sense. Each one of those perspectives contributes to the mosaic of understanding that is this whole ecosystem. And it allows the confidence and practice that comes from using those frames of reference allow us to act in the moment without hesitation at low emotional cost because we've seen those patterns and we've used these multiple time frames and layers of understanding and these different sense-making apparatuses to have the confidence that the rule is correct, so that all we have to do is see the event, sense and respond, simplicity of action, and we don't get paralyzed by trying to analyze all of these other things in the heat of the trade. I've already done that in the preparation. All those lines that I draw, the time that I spend when the market is closed studying the context allows me to act in the moment according to battle drill and not get paralyzed by analysis. So I'm acting more like a tiger, choosing my prey and striking as an apex predator and not worrying about it. But we are people, we're not tigers. So we have to deal with all of the emotional consequences of dealing with uncertainty, with the mountains of information that are out there and all the talking heads and all the different rules and systems that are competing in our head, that some systems say this, other systems say that. How do you make sense of all that? Well, you have to have some of this sense-making apparatus in place to give you an ecosystem approach so you have a way to adjudicate, so you know what rule that you're going to fire and you can act with intention and energy. You have to be mindful of the fact that the very human need for certainty is going to cause you to always question what you're about to do in the heat of the moment unless you have overtrained the skill to such an extent that you can silence that mind. Think about on the Sunday night podcast where I talked about in the preparation room in the dojo is where I fold up all my street clothes, leave the rest of the world behind, get my mind right, pick up my sword, and walk naked into the battle circle and fight. that's I already have the certainty about what I'm about to do with the rules that I'm going to use and trade according to the plan I've put together with my bulletproof mind. I've done all that in the preparation room. And when I get into the tactical trade, I am manifesting the behavior of a tiger and not of a chattering chimpanzee monkey person. So I handle my need for certainty by being very prepared. This whole metaphor of how I'm trading comes from a sense of self, which comes from a process of self-discovery. That process of self-discovery is what I teach in the learning management system courses on psychology. It teaches you how to use design thinking, where you figure out what your current state is. Sorry. You start with where you are in your current state and where you want to be in that future state. Have a very rich description of what that is and where you want to be. And then you start trying to do some things. You start moving out. You do, well, I'll just go there. And I try something, and 3 times I try it, and I keep running into an obstacle. So there's some set of problems that develop that keep preventing me from just simply going to where I want to go. In fact, enough problems, and you might start thinking, hey, maybe those problems that I see, maybe there's a real problem that's hidden that has a root cause. And so I start trying to study the problem frame and understanding the real root cause of what's getting in my way so that I can start trying some other things and take a way and try to find a way around that problem frame. And then what I'm searching for is the operational approach that allows me to get to my future state. And then this is called design thinking. So I have some kind of environmental frame that establishes the region in which I can act. So design thinking helps me deal with the problems that are coming. I think I can just go there, and I think, well, I'll just do it. Oh, and I get surprised by these failures. So after a while, maybe it's something else. So design thinking is how you start dealing with problems that are actually more complicated or complex than they seem to be on the surface. Um, Stand by. So I'm not going to cover this one in any great detail because we're already very far into this, but it just seems like a good time to do it. So what we do in design thinking is what I just here's a step-by-step process. Mapping your current state, future state, problem statement, operational approach. This is the next layer down. And then I also say, hey, what's your motivation? These things are getting after the emotional intelligence that give you the drive to deal with a world that is more difficult than I thought. Well, why do you want to succeed on this? What's the benefit? Why do you want to? Furthermore, why must you succeed? How are you going to overcome obstacles? Why are you going to keep going when it gets tough? Why is the world going to be better because of your success? Who's going to benefit from your success and why? Well, you got to get through all that stuff. That's the self-discovery of who you are and all that, so that you can do the design thinking that will help you come up with an operational approach that'll solve the problem for you. And then we break it out into these measures so we can actually plan and have a structured way to get going. This is what I do with all my doctoral candidates and the business executives that I help them with their strategic plans. So this is part of that process of self-discovery. and figuring out who you are and what you're about so that you can get in there and win. So after you've done that, start with your future state, your personal brand, and a strategic plan. Where are you going to be 5 years from now? Who are you? What are you doing? How did you get there? How would you describe your brand? And why will you succeed? Commit to that. That's the powerful magnet of the future state that's going to give you the pull to get through all this bullshit in the problem statement. You're going to do a SWOT analysis. You figured out, oh, this thing is not just simple. This is hard. You got to do design thinking. You're going to do a strengths, weaknesses, opportunities, and threat analysis and come up with different kinds of strategies that are going to allow you to come up with a plan to get through that problem, to come up with an operational approach that is suitable, feasible, and acceptable so you can actually get to that future state. Well, that's the beginning of the journey of psychology that is the guts of trading. Because when you step into the circle naked with a sword against an opponent who's ready to kill you and he's a tiger, that's a serious person on the other side of the trade. You better be ready for that. And if you're not, then you're not a serious person, and you might as well just write him a check now, because that's who's on the other side of the trade. Now, hold that thought. I'm going to pause and step outside of that frame. And I'm going to say that what I've just described is simply one metaphor for your house of trading. You can adopt any kind of metaphor that could work for you. And part of the discovery of self and design thinking is to discover your powerful metaphors and stories and narratives that allow you to act effectively in the world. For me, with a 40-year career as a combat infantryman and a martial artist and a competitive athlete, yeah, that's the model that I use in my head because that's what I understand and that's how I live my life. Everything in my life focuses on that metaphor and those analogies. That has real power for me. Whatever your chosen narrative is, has to have the kind of power that it takes to organize yourself and organize your thinking so that when you are dealing with this onion skin and trying to figure out which particular tactical rule you want to use and immediately find it, you got to get through all these layers of self-conflict, market conflict, environmental conflict, the fog of war that the opponent throws at you to throw you off your game. You got to be able to have a way to organize all of that so that when you figure out what needs to be done, you can sense and respond with simplicity of action, not get overcome by analysis paralysis. And then when you start thinking about the way you learn and the kinds of lessons that are out there to be learned, I want you to realize that there's like 4 different kinds of lessons. That's what this last little graphic is. I just drew this one today, and I really like the way it shows in a simplified way all the lessons that you're learning on your journey. The only reason that you even need to learn them is so that you can act in the world to make a difference for the better, to create value, to take risk properly, to receive the rewards of good judgment and action, and then put that to work for the betterment of the world. That's why you have to learn lessons. And there's 4 kinds of lessons that you can learn. You can learn lessons from the past. So things that went on before, the experience, you can learn experiential lessons and put those into action if you can, if you have a way to learn from your own experience reliably. Or you can learn from bottoms up attention to detail in the small things, the little nuances and improvements, the bottoms up lessons can be taught and learned and put into action. And then you can learn from top-down philosophies and systems and perspectives, and you can learn those lessons and put them into action. And then when you try to apply those lessons forward into action, you can learn from what you do and get better. So experiential learning by trading forward, that's what I'm describing. You saw all 4 of those different kinds of lessons today. You saw lessons from trades I've been taking. You've learned lessons that were talking about principles that need to be applied, like the need to deal with your need for certainty. That can get in the way. If you're waiting around for too much certainty, you're hurting the team. You can learn from bottoms up stuff like the power of the RLXD or shrinking the size of the minimum manageable risk box in order to get into the trades quicker. And then my advice to learn by trading forward with skin in the game. If you're going to use a simulator, then you better take it seriously, because if you don't, you're setting yourself up for failure. But if you take it seriously, you can learn by doing at a very low cost. Study the lesson from Alex Ressos on trading as a craft-based knowledge. Find that lesson on YouTube and on my homepage at tortoisecapital.net, and you're going to learn something from there. So that's everything I wanted to say tonight. We're already an hour and 40 minutes into this thing, but it just seemed like these were things that needed to be said. This is from that podcast note sheet, and now you can see it instead of my scribbling. These are the patterns that you got to know that I can teach you. Of the things I can teach you, those are the patterns you need to know. The hybrid frog, and really that minimum manageable risk box, the owl, the collapsing dragon, emerging dragon, what to do when it pinches, how to play continuations, and then the importance of that damn regression line cross and the dragon is gold. And then the processes, these top-down, these are the bottoms-up things. These are the top-down things. Core and turbo, fractal nature of time and pattern and markets, the 4 seasons of MACD, the multi-time frame, multi-lens, the ecosystem approach, and then this sense-making framework that allows you to connect the tactics with the strategies. RLCO Bollinger Band framework, the 4 seasons of MACD, how to use those regression lines in a fractal framework. Support and resistance lines. You see that every day on that market health check. And then the ideas of pinching and stretching, I want you to think of that as the market breathing. And learn to feel it breathing as a living organism, as a herd animal that has wolves in sheep's clothing out there. Apex predators, all living in that ecosystem. So those are the lessons I wanted to leave you with tonight. A lot of work for you to do. I'll get this published and posted. There is so much gold in that mine tonight. I can't even tell you. Anyway, there you are. Send me your questions. Hopefully that gets you started, Van. That chain trading course has hours of this stuff. That'll get you going. But those were the sketches I drew on my big whiteboard behind me today, because what is it that I need to convey to you guys tonight? Those were some essential truths. It was time to get out of the weeds of the tactical trading a little bit and get after some of this top-down stuff. Okay? So you heard some top-down lessons tonight, not just the bottoms-up bar by bar, what do I do with the green line? And not just the ideas about past trades, but how to learn by trading forward. And the key is effortless action. Wu Wei. W-U-W-E-I. Wu Wei. Look it up. Effortless action. That comes from all of the prep work. You can't you can't have so many damn rules that it stops you from picking the essential one for action. So you have to add and subtract in the tactical space, okay? That's everything I wanted to say. Take good care, guys. Wash your hands. Stay off the beach. Get a good night's sleep. Take good care.